$2,000 per month. For those three spaces, we focus solely on two asset classes. That's multifamily and self-storage.
So, talk to me after the whole due diligence, right? From environmental to walking the units, either it be multifamily or self storage. What point or at what dollar threshold do you go back to the seller and say, hey, we need to talk about this, right? Because obviously, going into, creating your LOI, your letter of intent, and your purchase agreement, you have this idea of what you're going to fix or what you're going to improve once you purchase the building. Tell me a little bit about your thought there. So, let's just do an example. Let's say that you're going to put $1 million of capital expense into the budget of repairing the property or bringing it to the next level. You do your due diligence and you found, $1.2 million of improvements and other things. So a total of 1.2. Would you go back to the seller and would you say, hey, I think we need to talk a little bit about this?
That's a pretty big difference. That's a 20% difference. So I think the answer would be yes, but I think there's a lot of gray there. And we've had scenarios where we haven't gone back to the seller for $1. And we've had scenarios where we've gone back to the seller for hundreds of thousands of dollars. And I think it really depends on a number of factors. So some of those might be the broker relationship on the seller side, for example. So in one instance, we did not make any concession requests at all. And one of the reasons we did was before we had that deal under contract. That's part of what we represented. We represented ourselves as folks who were very familiar with the market, with the specific asset, and we represented ourselves as somebody who wanted to build a relationship with that broker because I think that's something that's also very important. It's just building relationships, brokers in your market, because those are the folks that control deal flow. And especially in the commercial world, most of these deals are going to trade off market or pre-market. So we really wanted to build a solid relationship with that broker. And so we were pretty adamant that we weren't going to retrade in that instance. And fortunately, we didn't find anything too substantial. And we were legitimately familiar with the asset and with the market. So we had eyes on it before our due diligence period even started. So in an instance like that, we might not seek to retrade at all. But, as you alluded to, there are certain instances, whether it's from a physical perspective and there's just more work that's required, or even from an economic perspective, that's probably where we'll seek to get concessions more frequently. Is just when the seller, whether intentionally or unintentionally, has misrepresented the economics of the property. So we've had instances where the unit count has just been grossly understated.
While the unit count?
Yeah. So in a self storage facility, for example, so one that I'm thinking of, let's say there were 150 units. There were also three commercial spaces, those spaces that we could rent out on a monthly basis for much higher rent. So call it $2,000 per month for those three spaces. And on the rent rolls that were provided to us, they were basically double counted just and this was more of a mom and pop seller. We don't think it was intentional, but just in the way that he was accounting for this on the rent roll, it was basically appearing twice, both as a storage unit and as a commercial space. So the income was way overstated. And once we got on site, we did our unit audit. We brought this to the seller's attention and he said, oh, yeah, that's just how I do my accounting. And so the numbers were way skewed as a result of that, led to us needing a concession to move forward. And, I think that really underscores the importance of doing that economic due diligence because I think in a lot of instances, that's sometimes even more important than just your renovation budget.
Yes, for sure. Now, when you're looking at leases, do you take it a step further and look at bank account? Like, was the money actually deposited into the seller's bank account? Do you take it that far when you do your due diligence, or do you just kind of stop and say, "Oh yeah, $400 for this or $800 for this lease," and you look and the lease matches, and then you take it for what it's worth?
Yeah, another question where the answer is it depends. Sometimes we do review bank statements, and in the instances where we do, it's most likely an instance like I just described, where it's more of a mom and pop seller. We're not dealing with a professional management company or any sort of reports that were generated by software. We're dealing more so with, let's call it, handwritten reports. Some instances we might not even have seller tax returns, so we really don't have anything to tie those to other than bank accounts. So in those instances, we would look to tie the income to something.
Yeah, that's a great point. So I hope the audience is listening. There was a lot of depends on the answers, right, that you gave, and with good reason, right? So having a team that's flexible and that knows how far to take it and when to take it further and when not to is extremely important in the success of any investment that's made or with any group of investors that you make it with. So that's a great point. And I would agree totally, right? Depending on how far we take a lot of these things as well. Us too, we're in multifamily as well as self-storage and a lot of different other asset classes. Let's probably spend the next few minutes just talking about diversification of investment portfolio and why you think that's so important. And then the other side of that question question is, what else do you use? What other asset classes do you have in your portfolio to help diversify your investments?
Yeah, I think diversification is key, and there's always that balance between being too niched on one asset class or one strategy and having object syndrome and kind of bouncing around. So for us, we focus solely on two asset classes. That's multifamily and self storage. I think just inherently in the asset classes that we focus on, they're almost diversified in and of themselves just because they are larger assets. So in a self storage facility, for example, we might have 200 units and we might have 180 tenants, let's call it. So if 5 or 10 are in default, that's not necessarily going to torpedo the project or the business plan. Whereas, call it a single family home or a duplex, if 1 or 2 tenants default, that's going to have a much greater effect on the bottom line. So I think just the larger assets in general have slightly higher margins of safety, depending on your due diligence, of course, and purchasing it at the right price and operating it efficiently and everything like that. But assuming apples, I think just the fact that they're larger just makes them slightly safer. And then markets. So for us, we're mainly in the Midwest and we're mainly in Indianapolis, Louisville, Memphis areas. So our hubs mainly within a few hours of each other in those directions. But we are in a handful of markets, and I think that diversification is key too. Just in the event that something hits one market, whether it's economic or environmental, we do have that added flexibility there.
So while they're not diversifying in other asset classes, they're diversifying by size and they're also diversifying by region, which is just another way, guys, to think about diversification, right? It could be small and large multifamily, small and large self storage. It also can be in different regions and so on and so forth. So when people say, how do you diversify? That's definitely a way to diversify your investment portfolio versus being in investments that cross gold and silver all the way through to multifamily. So I know some people that do that as well, and that's not a bad thing. Again, it's your risk tolerance, it's what you're interested in, right? So I don't think there's a wrong answer with you being diversified. I think the wrong answer is if you're not and you can't describe it, right?
And I think you hit the nail on the head. It's just about your risk tolerance and just not putting all your eggs in one basket. And I don't think there's any strategy that's the best strategy. The best strategy is really just whatever strategy you feel the best about.
Or what's important to you, right? Is it cash flow? Is it appreciation? What do you need today? That's another thing to kind of think about. So, Michael, this has been great. What's your final thought that you want the users with?
I'd say just lean into the uncomfortable. That's something that once we started to do that, we saw a lot more progress in our business. And there's just a lot of parts of real estate where maybe it's the first time that you're doing something, or maybe it's something that's slightly larger than what you're accustomed to. But as you lean into that, that's where the real growth comes from. And I think that's when you're going to see the most progress.
Fantastic. So, Michael, if people want to find you and talk more about your company or what you do, where can they find you?
Yeah, I'd encourage folks to head to our website, nextplayinvestments.com, and feel free to reach out to me via email or book a call with me and be happy to chat.
Fantastic. Well, Michael, thank you so much for spending a little bit of your afternoon with us today, and I'm sure we'll be in touch.
I was trying to think through the passive cash flow and then passive real estate investing. You can prepay or you can basically pre-buy something which is still building. And it's a lot cheaper.
Jacqueline and Melvin, thank you so much for taking time out of your busy day to listen to this episode of Get Diversified. Please make sure to subscribe to our podcast so you don't miss out on future episodes. Finally, stop by our website and follow us on social media. Ciao for now. Make it a great day, and we'll see you next time. And remember, get diversified.